All right, welcome back, everyone, to the deep dive. So, Texas Instruments, they just dropped their Q2 2025 earnings.
Mhm.
And, the top line numbers, they look pretty strong. Revenue up, 16% year over year. But then you listen to the call and, the CEO sounds, well, maybe a bit cautious about what's next. It's kind of mixed signals, right? So today we're going to dive into their earnings call, the financial release, try and cut through the noise. We're looking at these two big forces they mentioned, this market recovery, yet, but also all the, geopolitics stuff.
Uh-huh.
Our mission really is to figure out what's actually going on behind the numbers and what it means for tech and for you.
Exactly. And that tension you mentioned, that's really what we need to unpack. You've got this semiconductor cycle recovering, which is one thing. But then layered on top is all this disruption from, well, geopolitics, tariffs. It's complicated. So yeah, we'll hit the numbers, the hard figures, but we also need to get into the strategy. What's TI thinking?
Mhm.
And what does it signal for the wider market, how companies adapt?
Okay, so let's jump right in with those core numbers then. Because, yeah, that's the foundation. TI reported Q2 revenue of $4.4 billion,
Right.
which is up, like you said, solid growth, 9% sequentially, and that impressive 16% year over year.
And the segment breakdown was pretty strong too.
Yeah, analog was up 18% year over year, embedded processing 10%, and their other segment 14%.
Mm.
Gross profit hit $2.6 billion. That's 58% of revenue.
And that margin ticked up a bit sequentially, right? 110 basis points.
Exactly, just over % better than last quarter. Operating profit, $1.6 billion, up a big 25% from the year-ago quarter. That's 35% of revenue.
Okay.
And net income landed at $1.3 billion. So earnings per share came in at $1.41.
Which was actually a bit better than they guided, wasn't it?
Yeah, they mentioned a 2-cent benefit that wasn't in the original guidance, so
Yeah.
strong numbers, definitely.
Undeniably strong. But like you hinted at, it's how TI themselves framed it. They specifically highlighted these two almost opposing forces shaping things.
Right, the distinct dynamics, as CEO Heavy Ellen called them.
Yeah.
So force number one is that ongoing cyclical recovery in semis. That sounds good. Normal, almost.
The market coming back.
But number two is how tariffs and geopolitics are actively, messing with and reshaping global supply chains.
And that's the complex part. It's not just business as usual.
Definitely not.
So if we look at the bigger picture, the cyclical part, well, customer inventories are still low. That means there's real demand out there. TI feels, pretty good about their capacity, their inventory to meet that.
Okay, that makes sense.
But then the geopolitics side, they're really emphasizing their global manufacturing footprint, using that for flexibility.
Even with the current U.S.-China semiconductor tariffs being sort of on hold.
Right. They're basically saying, we're ready for things to change. They have to be agile because these are big geopolitical shifts, not just economic ones.
Okay, so let's dig into where the money's actually coming from, the end markets, because that tells a story too, doesn't it?
Absolutely. Where is the recovery strongest, and where is it?
No. Right, so the industrial market, they said upper teens growth year over year and mid-teens sequentially. Recovery pretty much everywhere in industrial.
Okay, strong there.
Personal electronics, up around 25% year over year. Sequentially, upper single digits.
There's still good growth.
Enterprise systems surged about 40% year over year and 10% sequentially.
Wow, 40% year over year.
Yeah. And communications equipment, even bigger year over year.
Yeah.
More than 50%. About 10% sequentially, too.
Okay, so those are some pretty huge numbers across most markets. Anything jump out at you there?
Well, yeah, those are big jumps. But you mentioned earlier how TI framed things.
Right, and the industrial market is where that framing really comes into play. They described it as running very hot in Q2.
Yeah.
That 15% sequential jump. They called it a little bit unnatural.
Unnatural. Why?
Well, part of it was driven by a really strong pull from China. TI's China revenue was up 19% sequentially, 32% year over year, and industrial was leading that growth in China. But TI suggested, especially earlier in the quarter, maybe some customers were pulling in orders.
Because of the tariff noise you mentioned. Building a bit of extra inventory just in case.
Exactly. So it might not have been all pure underlying demand recovery. Some of it could have been strategic stocking, a mix.
That's a really important nuance, not just pure demand signal then.
Right.
Okay, now for the odd one out in this picture, automotive.
Yeah, what happened there?
Well, year over year, it was up mid-single digits, which sounds okay,
Right.
but sequentially, it actually decreased. Low single digits.
Oh, wow. Down sequentially while everything else is mostly up.
Yeah. They see this market as lagging, maybe by about a year compared to industrial. They called the recovery shallow.
Hmm. So not really back yet.
Not fully. And orders are apparently almost real time. There's no big inventory replenishment happening at the car makers, the OEMs, or their Tier 1 suppliers.
Interesting. Even in China. Because the overall China auto market has been pretty strong, hasn't it?
You'd think so, but TI said their auto business in China performed similarly to the rest of their auto segment. They think it's an inventory correction on the customer side there, too.
So even China auto wasn't immune to this correction for TI. That sequential decline is definitely notable.
Okay, so selling tons of chips, mostly.
Yeah.
But how are they managing all the cash coming in? Let's shift from sales to the financials.
Right, the cash flow story.
They generated $1.9 billion in cash from operations just in Q2.
Pretty healthy.
And $6.4 billion over the last year, the trailing 12 months. Capital expenditures, CapEx, building factories, buying equipment. That was $1.3 billion for the quarter.
And quite a bit over the year.
Yeah, $4.9 billion over the past year. So their free cash flow for the trailing 12 months ended up at $1.8 billion.
Okay, $1.8 billion free cash flow. But what really stands out is how much they returned to shareholders.
Oh, yeah.
In the last 12 months, they returned $6.7 billion. That's huge.
Wow, $6.7 billion back to owners. How did they break that down?
It was $4.9 billion in dividends and $1.8 billion in stock buybacks.
That really does show the strength of the underlying business model, doesn't it? Generating that much cash.
Absolutely. And they still maintain a strong balance sheet. $5.4 billion in cash and short-term investments.
Even after taking on some debt.
Yeah, they issued $1.2 billion in debt recently. Total debt is now $14.15 billion, but at a pretty good weighted average rate, about 4%.
Okay, and looking ahead on that spending, the CapEx.
They're planning $5 billion for 2025.
$5 billion. And for 2026?
Between $2 billion and $5 billion. So still significant ongoing investment.
That continuous heavy spending on capacity, that's clearly key to their long-term plan, right? Yeah. Especially given the geopolitics we talked about.
It absolutely is. It signals they want control over their manufacturing, which brings up the question of that new U.S. tax legislation. How does that play into this?
Right. The CAPS Act related stuff and tax changes, they sounded pretty happy about it.
Yeah, very pleased, I think, was the phrase.
They highlighted being able to immediately expense U.S. R&D and eligible CapEx.
And the investment tax credit, the ITC, got a boost too, right?
Yeah, from 25% up to 35%. That's a direct tax break on those big investments they're making.
So even if their main tax rate, the GAAP rate, goes up a bit in Q3.
They expect their actual cash taxes to be significantly lower for several years.
Which boosts free cash flow. So yeah, pretty substantial financial tailwind supporting that big investment strategy.
Okay, so we've got the recovery, we've got the tariff uncertainty, the strategic spending, the tax benefits. What does it all add up to for next quarter's outlook?
Well, their Q3 guidance reflects that complexity, I think.
Revenue forecast is $4.45 billion to $4.80 billion. And earnings per share between $1.36 and $1.60.
So the midpoint is slightly up sequentially on revenue, but maybe not a huge jump.
Yeah, and they really emphasize being ready for, a range of outcomes,
Right.
Staying flexible.
Which connects back to the bigger picture. There's definitely some deliberate caution in that Q3 guidance.
You think it's not necessarily the recovery stalling, but more. Accounting for that Q2 weirdness.
Exactly. Accounting for those potential pull-ins, maybe driven by tariff worries back in Q2, which might be normalizing now. Their strategy seems very focused on the long haul, strengthening competitive advantages like manufacturing, tech, their product range, how they reach customers.
Playing the long game, like you said.
Definitely.
And speaking of that long game, especially with geopolitics swirling,
Right.
They really leaned into their U.S. manufacturing footprint, didn't they?
They did. They highlighted building it up over the last 5 years, calling it geopolitically dependable capacity.
Which has got to sound good to customers worried about supply chain stability, right?
For sure. But does that heavier U.S. focus maybe come with trade-offs? Cost, perhaps, compared to being more globally spread out?
That's the question, isn't it?
Well, TI seems to believe that the opportunity from U.S. chip incentives, like that ITC boost, they said it's greater than our challenge. They think the scale and affordability they can get from their U.S. plans outweighs potential downsides.
So it's a calculated bet.
A calculated bet on long-term stability and leveraging those incentives. It hasn't fully played out yet, they admit, but it does position them, well, uniquely for whatever shifts come next.
So wrapping this deep dive up, It really shows TI navigating a pretty tricky environment.
Yeah.
You've got the clear cyclical recovery, 4 out of 5 markets growing nicely.
Right.
But then you have this constant dance with tariffs, geopolitics, adding uncertainty, leading to that cautious, flexible stance.
I think the core takeaway is how they're using those big strategic investments, especially in manufacturing, especially in the U.S., to try and control their own destiny. They want to support customers globally, sure, but on their terms with reliable supply.
And their focus stays on that long-term free cash flow per share growth.
Exactly. It signals a business model built to adapt, not just react.
So for you, the listener, this is a really good window into how these huge industries aren't just passively responding to the market, they're actively trying to shape their future, even with all these global complexities swirling around.
Yeah.
And it leaves you with a pretty interesting question, doesn't it? As tech keeps advancing,
Yeah.
how much will future supply chains really be driven by just economics, the cycles, and how much by these geopolitical chess moves?
That's something to think about, definitely, as you use all the tech that companies like TI help power every day.